Hey guys, welcome to Make Money Count. I'm back here in the studio with my friend Marcus and happy to be back. I was away last week. You did a podcast without me, but that's okay. I forgive you. I think today we'll just jump right into it. And Marcus has his pen in hand, so we all know what that means.
Bond yields.
Yes, let's do it.
Why don't we start with bond yields and then talk about the massive amount of inventory that has come in to the market and why and what that is going to look like in the coming months. So first up, you want to throw bond yields up for me, Austin? Bond yields are down. They are now moving down.
Good news for mortgage rates.
Yeah, I think we're going to keep seeing bond yields moving down.
Amazing.
There is, you know how when things are going bad,
Okay.
you can't, like everything is going bad. Like you can't think of anything that's going good when things are going bad.
Stinking thinking, I think they call it.
Oh, really? That's what they call it? Okay. So our economy and our consumers and the sentiment in our economy is now undergoing stinking thinking.
That is.
Right? And there's nothing better lately to identify sentiment than this bond yield chart. And I know it's a little sticky because obviously the Bank of Canada and like all of the central banks in the G7 are primarily concerned about inflation.
Right.
But that is coming off. And we've always talked about this, right? It's hard to say when exactly interest rates are going to come down because it is so predicated on when the economy starts to feel the strain of those higher interest rates. And believe me, we are seeing it now. And nowhere is it more clear than new listings and real estate supply. And that will eventually trickle into everything else. So we talked about this a little bit when you were away, but we saw the Bank of Canada give a 25 basis point rate drop. This reprieve did nothing to instigate buyers coming into the market. But what it did do was it brought on all of the sellers,
right.
Not all of them yet. Okay. And the scary thing here is we've got a ton of sellers flooding the market. Do you want to pull up that TREB report? Yeah. So the Toronto Real Estate Board did a piece on what they're seeing as far as changes. Transactions are down. So transactions are down 16%, seasonally adjusted less, but scroll down a little bit more. I mean, they're up slightly from last year, but that means nothing. And the year over year selling prices are down, and then total new listings, which is the real killer, are up. RBC Economics did a report which shows an even greater contrast to the amount of units that have flooded into the marketplace and the lack of demand for those units. So there are reports coming from all the major banks, and then there are numbers that we're seeing in listings. What we're starting to see now is people pulling their listings off of the market. So it's going to, hopefully it reduces the amount of supply that's out there. But the trend that we're going on, if we continue to go on this trend, there will be so much more supply coming to the market. And without a significant rate drop, no demand.
Right. I mean, I think the problem with people pulling their listings off the market is they're just weathering the storm for everybody to put their listings back on the market again, you know, in the spring market next year or
fall,
or whatever. Yeah.
It's this weird thing that you keep hearing, right? It's like, oh, everybody was looking forward to the spring market because interest rates were going to be lower. And then interest rates came down 25 basis points and it didn't bring any buyers into the market. It just brought sellers.
Yeah.
So those buyers are still waiting on the sidelines. And then the longer interest rates stay high for, the more fundamental issues start occurring in our economy, right? So right now, for example, we've got a ton of supply. All of that supply sitting in the marketplace and no transactions for new home sales, right? So developers have left the building. Investors have left the building. As a result, the construction industry that feeds all of this is dead.
Right.
That's going to result in layoffs, which is going to increase our unemployment rate, right? Unemployment continues to go up. And we were saying that employment was so strong in Canada. It's not strong anymore. And the trend is leading us to a place of continued weakness.
Right.
Unemployment is going to make this economy what did you say? Stinking thinking?
Stinking
is going to be
thinking.
one part of this stinking thinking.
Right.
So look at what we've got now as far as headwinds coming at us, right? We got these high interest rates, which we just dropped 25 basis points. It didn't really do much. We're hoping to get another 25 basis points. July 16th, we see that CPI number, and that will tell us whether the Bank of Canada will give us another 25 basis points in July. It's probably not going to be 50. It might not even be 25 in July, right? Maybe we're going to wait till September or December. And the thing that we're going to be waiting for, obviously those CPI numbers, but unemployment numbers are going to keep going up. We're going to keep seeing more and more inventory hit the market as people who are holding on to their homes can't hold on anymore.
Yeah,
right?
you can only weather the storm so much.
Investors, we did this little piece last week about how condos are like the dividend stock, right? Investors no longer want to buy condos, right? They don't make sense. They're too expensive. The rents aren't enough to cover the servicing costs, and the prices are dropping. The prices might seem sticky in some of these numbers, right? You know, I've read so many different articles, and some of them say like, oh, you know, the spring market is starting to come back and prices are stabilizing. Bullshit. You can't stabilize prices when demand and supply are in such flux. You got massive amounts of supply coming to the market, as you're seeing from the TREB and the RBC economics report. You're seeing no demand, no buyers coming into this market because interest rates are too high and people are too worried about what's going to happen to those condo prices, to those housing prices. I think we're going to see further drop in pricing until hopefully interest rates can save some of that demand and buyers to come in. But what happens if unemployment continues to shoot up?
Right.
The economy is not in a good place right now. The banks keep saying that we're in for a soft landing or that interest rates are going to repair all this. I really hope so. But from what I can tell right now, we need interest rates to come off sooner rather than later in order to hopefully stabilize this marketplace. You look at this is happening it's not just a Canadian thing. It's every G7 country is experiencing what we're experiencing right now. If you look at it, and like some of them are more advanced than us, like they're further along on this cycle than we are, and some of them are behind us. Like the United States has productivity. They've got a few companies like the Magnificent Seven that are, you know, just creating massive amounts of wealth in their stock market. Canada doesn't have that.
Right.
So Canada's further evolved along this kind of G7 line of what happens when interest rates are really, really high and asset prices start crumbling. So it's, listen, we can only hope interest rates come down in order to help stabilize this. But I do not see price growth in 2024 is done. Prices are going to come off more. Hopefully in 2025, without interest rates coming off, prices are going to stay low and they're going to keep going lower. Yep. And the economy is going to keep feeling pain. Unemployment numbers are going to keep going up. I don't see any other solution for this. There's no other, like, you know, we talk about immigration. Well, so immigration used to be this kind of bullish case for why housing prices were going to stay high because we're letting so many people into the country. Well, we're going to cut immigration now, right? So this experiment that we did of flooding our country with non-permanent residents and new entrants and immigrants, it's over. And that will result in weaker demand for real estate. So it is kind of a lot of headwinds, like I said, and total stinking thinking. And the longer it goes on for, the worse the thinking will get.
Yes.
Right. So now think of it, the Canadian consumers like looking around the house. They're like, oh man, okay, so housing prices are dropping, interest rates are sticky, unemployment is going up, the demand from new entrants into the market is going to be gone. Now they're looking at things like productivity, right? The productivity of a Canadian worker is less than an American worker. Our GDP is falling relative to our peers. We are going to see more and more of this stinking thinking uncover more and more problems. And we're going to be in a bit of a spiral of this negative thinking around our economy. Everything was the exact same when interest rates were low, right? We had essentially the same economy. We just had really low interest rates.
Yeah.
Once those interest rates got jacked up, the stinking thinking started.
Right.
So where do we go from now? I am not entirely sure. I think we're going to see lower housing prices in the short and hopefully not medium term. Hopefully that reduction in interest rates by the Bank of Canada to a more normal level can bring back some of that demand. And hopefully it can also get some of the people who are selling units right now to say, oh, I can now manage these payments. I don't need to sell.
Right.
But there's another thing that happens in these situations where people are holding on and they're using other debt to hold on. So credit card debt is increasing. Line of credit debt is increasing. That masks some of the problems in the economy, but it doesn't mask them for long.
Right.
And what ends up happening is there's like a point of no return that gets passed where the credit card debt has reached a level and the line of credit debt, that unsecured debt, has reached a level where even if the debt servicing costs come down, it's no longer manageable.
Right.
So the supply side, or the kind of motivated vendors, continue to increase regardless of us seeing rates come down. It all comes back to this notion that interest rate increases or decreases are not felt immediately. There's a psychological impact right off the bat of, oh, wow, we got 25 basis points, we got 50 basis points, or, oh no, interest rates went up 1%. But the impact of it is felt 12, 24, 36, 48 months down the road because people are trying to deal with this. Scary times.
And what do you think if we did see a new government, how do you think that would kind of play into this? Because I don't think Trudeau's going to survive another.
Yeah. So, I mean, like, it could be more negative.
Right.
Think about this. We have increased government employees by like 50% under the Liberal government.
Right.
So if we see a Conservative government come in and cut federal employees, that's only going to add to unemployment. Right. We've created such a problem right now with our economy that a new Conservative government coming in isn't going to be able to solve all of these problems. Right. They're leaving a total mess here.
Yeah. For them to clean up. Well, that brings me to my portion of interesting headlines, mortgage headlines in the news today. Cue the fireworks. No fireworks. There you go. So 2 articles that I sent over to you today, which I'm going to kind of recap and we can chat about a bit. But one, you were talking about credit card debt and all that stuff. So we are now the 3rd most indebted country in the world, behind Switzerland and...
Look, should we guess at who number 2 is?
I'm going to say...
It's somebody with high asset prices.
Is that Australia? Australia. Yeah. Interesting. So yeah, 3rd most indebted country. Some other facts that I pulled out of there.
Australia, is one of those countries that's a little bit ahead of us in this cycle.
Right.
Like, so if you pay attention to the Australian central bank, they started cutting a little bit sooner. Their real estate prices jumped up a little quicker than ours did. They're ahead of us on this curve.
Right.
So that's interesting to see that it just kind of keeps going.
Yeah.
Yeah.
Well, I'm sure we'll be in second in no time if that's the case.
It depends.
Yeah.
Right. So what happens, right? Like asset prices get compressed and debt kind of continues to increase.
Right.
So I don't know. Well,
we'll see. Maybe we'll do an update in a couple of weeks or a couple months.
Sure.
The other interesting things I pulled from this. So the top 2/5 of households based on income hold 55% of the debt, and the bottom 60% based on income hold 45% of the debt. So that's interesting too. Meaning like the highest income earners hold the most amount of debt.
40% of the people have 55% of the debt.
Yeah.
60% of the people have 45% of the debt.
Yeah.
So higher income earners have amassed more debt than lower income earners.
I guess that comes down to mortgages too, though, right? Because higher income earners would have higher mortgages.
Right.
So
the crunch really comes when asset prices come down.
Right.
Because if that is mortgage debt and it is secured against real estate, asset prices come down. Does any of that stuff go underwater?
Right.
And then like, poof.
Big problem.
Yeah. And I think like take your cue from the banks. Like there's no other market in the world where banks so tightly control everything, right? We got 5 banks, 5.5 banks, and those banks work together and they are the biggest stakeholder in real estate in Canada.
Right.
Because they've lent all the money on that real estate.
Right.
And take your cues from what the banks are doing. This is why I was telling somebody today, this is why I think the next solution here is actually probably more debt. Right? There's no other way out of this. And if you take your cue from the banks, like what are the banks doing, right? The banks lent these massive loans to developers. The developers built these buildings. Developer built a building, got a loan for $500 million, then sold 500 units, right? the building now is registering. The bank has come in and decided to leave the purchase prices as the values of the units that are being purchased, even though values have dropped below the purchase price for a lot of the people that have bought in these condos that are registering right now.
Yeah.
So they're making a decision to distribute this loan, to diversify that $500 million loan into 500 loans of $1 million to 500 people.
Right.
They're doing that in the hopes that prices are going to stabilize and they're going to come back, hopefully, to where the transactions occurred at. If they don't, then they're just going to have more defaults. They're kicking the can down the road, right? They did that with COVID, though, right? Forgiveness on interest or moratoriums, periods where people didn't have to pay interest. So the banks are making a decision to keep a very long-term time horizon on values of real estate, and they're not reacting, and they're allowing loans to kind of go over on amortization. They're allowing loans to be completed and approved at values that are actually higher than what they know the value of the property is today. All of these kind of show a level of confidence. Like when you read these reports from the banks, like that Royal Bank report, inside of it, they're talking about 2025 being a kind of return to more normalized small price increases, which would be great for the market. I just don't know if it's realistic to think that the small drops in interest rates that we're seeing are going to bring buyers back to stabilize prices as quickly as they anticipate.
Right.
And maybe I'm missing something, right? Because these banks have more data than any of us, right? They can see what credit card debt is at before we see it. They can see what, savings accounts look like. So if we're going to take a cue from the banks, a cue would be that the banks are going to be patient and they're going to keep letting this play out in the hopes that real estate prices stabilize.
Right. Interesting. I mean, when I think of because I was just in the US last week, the housing prices there it's crazy what you can buy a house for. It's nuts. I mean, anyone could have, well, maybe not anyone, but it's a lot more affordable over there.
Depending on what market you're in.
Of course. Yeah.
You were in Destin, Florida.
I mean, listen, hell yeah. It was beautiful there. Yeah. Also too hot. I would not live there. Very hot. Second article, which you can put up and we'll put on the screen and maybe post a link to, is that 3 in 10 Canadians are unhappy with the cost of living in their province and that they're interested in
You know what that is?
What?
Stinking thinking.
And they're interested in either leaving their province or leaving the country altogether. Out of those 3, 55% said that they're unsure where they would go or they'd rather leave the country than go to another province in Canada. So,
I mean, we know that there's interprovincial migration happening right now, right?
Yeah.
Like we can see people are leaving Ontario and they're going to Alberta.
Yeah.
How long does that last for? And when does that normalize, right? Yeah. Like these are all
the new normal is bullshit.
The new normal is totally bullshit. Stinking thinking's bullshit too.
Yeah.
Right? Like
100%.
This is like the fundamentals of what are going on have always kind of been there. The only thing that's changed now is interest rates.
Right.
Interest rates are high and the market is tanking as a result. But keep in mind, the central bank wants the market to tank, wants unemployment to keep going up. Yeah. They want to see a reason for them to be able to reduce interest rates.
100%.
The thing that worries me is what happens if interest rates come off and the demand doesn't come back?
Right.
Maybe I'm just overthinking it.
That
right
would be
now,
bad.
Right. And then how much more do interest rates have to come down? And then are we back in the antithesis of the George Clooney maneuvering the central bank? Right?
I was just thinking about that.
Yeah. This is not a very, nimble, delicate maneuvering that's going on right now. This is 200 basis points needs to come off the overnight rate.
If they were only this careful dropping the interest rates, then you know what I mean? Or
they are being careful.
Increasing the interest rates.
Increasing it.
Yeah.
Or maybe if they were only this careful when they dealt with the response from COVID.
Right.
What we're dealing with right now.
Flew a plane over and just threw money at everybody.
Yeah. This is the COVID hangover.
Yeah.
This is what we're dealing with right now. This is our economy is experiencing long COVID.
Interesting. You were talking about, so one of the other, there's another article that I didn't pull up today, but you were talking about interprovincial moving. Winnipeg had their third best real estate performance ever only ahead of that was 2021 and 2022.
Wow.
But once the winter comes, everyone's going to want to leave anyways.
Yeah, I don't know.
No. And then the last fact from that little article there, and you were talking about immigration before, 75%, it's talking about how 75% of permanent residents became citizens in 2001. And in 2021, only 45% of
people are not staying.
Yeah, they don't want to stay here. They don't want to stay here. So we haven't made a welcoming environment.
Well, think about it, right? Usually immigration happens because people want to come to a country for economic opportunity.
Yeah, that doesn't happen here.
But again, like the Grand Dam Hotel that we have here, people are coming because of the reputation.
Right.
But when they get here, they're finding out that things aren't as great as what they expected them to be.
Right.
And there's many reasons for that. Canada specifically is an infrastructure problem.
Right.
And we need to better our infrastructure to increase our productivity. In the meantime, high interest rates are just stifling the economy and will continue to do so, right? Like this decision now of higher interest rates for longer is the next shoe to drop is going to be the construction industry, right? Construction industry goes away, which is a massive contribution to GDP in our country. We'll see further declines in GDP.
Right.
And when you lay off farm workers and, demolition and plumbers and like all of the people that we so desperately need on a long-term basis to build the infrastructure for our country, when those jobs start going away because we can't bring supply online because the pricing of it just doesn't meet demand requirements right now, right? That there's like a imbalance in the supply demand curve. We cannot supply housing at a price that the demand is willing to acquire it for.
Yeah.
So either demand has to come back at that acquisition price, read lower interest rates, or we have to find a way to rejig supply to reduce the cost of delivering units.
Right.
In the meantime, deadlock, no housing coming online. Well, I mean, all the stuff we've got that's got to get finished. There's 100,000 units that are going to get finished now. So in the next 2 years, 100,000 units are going to come online. 2025's got more units. Those are all sold. But what happens in 2025 when the people that bought at the absolute peak now have their unit coming online? Do the banks decide then that they don't want to diversify those big, ginormous loans that they've got to the developers? And at what point do they pull back? Or are they hoping that, and banks don't hope, right? We talked about this like a long time ago. Do you remember the CEO of Royal Bank, like early on in this period when we were all clamoring for rate drops, said, and this is like a year in advance, he said in June of 2023 or in September of 2023, we did a podcast. Peter MacKay came out and said, we are going to see the first rate cut happen in June of 2024. And I said, he is not predicting, he is telling.
Right.
He is telling the Bank of Canada what he wants to see.
He's privy to information.
Because between September of 2023 and June of 2024, a lot happened that could have led you to believe that rates were maybe going to go up. They were going to go down faster. But no, sure enough, like clockwork, we saw 25 basis points in June. That same bank is producing reports right now that are saying demand will come to meet supply in 2025.
Right.
That's what they're saying in the report.
Right.
I'm not saying it.
Yeah.
That same bank also has hundreds of billions of dollars of exposure to the residential marketplace. That same bank has billions and billions of dollars lent out to condo developers who are hoping to close those condos in 2025, who have closed them in 2024. Maybe the bank is going to further guide this economy with lower interest rates. And if I was going to make another prediction, it would be, I think we're going to start seeing maybe not interest only mortgages, but like we're starting to see musings of like longer amortizations.
Yeah.
Okay. So Switzerland, the number one economy on your list there, which was great, by the way.
Yeah.
The number one indebted consumer also has interest only mortgages.
Right.
So there is a progression that an economy goes through. I don't know if it's a good progression. I don't know where it goes in the end. Where does this go?
Right.
But just like quantitative easing. I had never heard of quantitative easing before the end of 2008. And then the Federal Reserve said, we're going to embark on quantitative easing. And what it meant was they're just going to print a whole bunch of money and sop up demand for bonds or supply. Just flood the money into the marketplace in order to stabilize and make it liquid and keep asset prices trucking.
Yeah.
So have we reached a point where asset prices are so critical to social stability that we can't afford for them to drop too much? And is that what we've seen happen over the last 30 years now?
Right.
Like, remember the 90s were the last time we felt a real kind of drop in real estate prices like this.
I was in a
30-year, yeah. Well, we've been on a 30-year run for real estate prices. We're due for a correction.
Right.
The problem is, and like it's that old Howard Marks saying, right? The pendulum between fear and greed swings wildly, and it never rests in the perfect position. So right now, our pendulum is swinging towards fear.
Right.
How much further will it swing, and what can be done to mitigate the damage? And in our economy, certainly the stakeholders that are going to mitigate that damage are the Canadian banks.
Right.
It's going to be super interesting to watch play out. We are going to keep talking about it. I feel like we used to talk about so many other things, and now it's like, boom, we're just dialed in on this.
I mean, we're like a good balsamic reduction.
Yeah.
We just know what we need. Nice and flavorful. I think that's it.
Yeah.
I think that's it.
So will the balsamic reduction be able to prevent stinking thinking?
Find out next week.
In the meantime, please like, subscribe. Listen, I hate even saying it, but if you like our video, it puts us up in the algorithms of YouTube and it makes sure that more people get to see it. So we thank you very much for continuing to listen on Spotify and Apple Podcasts. We want more of you to watch and listen on YouTube. So thank you very much.